is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Central bank bonanza. Now, it's a pivotal week for markets with no fewer than 11 meetings, including the Fed, the ECB, and the BOE. Stocks kick off in the red while the dollar climbs. Power surge. London wakes up to the season's first snowfall as heating demand drives energy prices to records. Meanwhile, the UK braces for a prolonged series of strikes. And logistics change while shipping giant Maersk names Vincent Clerc as incoming chief executive, taking over from Søren Skou after 6 years at the top. And you can see shares for the moment down 2.3%. Now, first thing is first, so let's check on the markets, European stocks, but also U.S. futures actually declining at the start of a pivotal week for markets because of all those interest rate decisions. Fed, ECB, but also a host of their peers. Investors really looking for firmer clues on how far and how fast central banks will tighten monetary policy from here on as recession fears resurface. I think we also have a map of Europe, if we can see it really quickly. I'm sorry if it's very, very tiny, but we will get to it to see whether there's a difference between the DAX and some of the others. You can see for the moment all in the red, and I'm also looking at the 19 industry groups that make up the European stocks, and they're down. Maersk saying Vincent Clerc taking over from Søren Skou as new chief executive. We'll have plenty more of our interview with the incoming chief executive, Vincent Clerc, later this hour. That share price down 2%. Now, we're joined to talk about the markets by Mike Bell. He's global market strategist at JP Morgan Asset Management. Mike, great to speak to you. What a week for central banks, and what a week actually for an investment trader. Like, where do you see the fault line?
I mean, for me, the interesting question is not so much about what happens this week, because I think probably the market's right on what's going to happen this week. The big question really is about where are rates going to be at the end of 2024? Yeah. Because the market's already starting to price some cuts. I think that's because the market knows a recession's coming. But is the market pricing enough cuts for a recession? It's not clear to me, both in the UK and the US, that it is.
But so, Mike, is it now given that we're going to see stagflation, even in the US?
I mean, I think the question there really depends on how you define stagflation. I think we're going to get a recession, and obviously inflation is very high at the moment. So in that sense, yes. But for me, the question really is, does the recession bring inflation down? And I think there's a good chance it does. I think unemployment's going to rise to a level that brings wage growth down, and that will moderate the inflation pressures in 2024. So,
Mike, if we look, and we had this great conversation actually with our head of equities, a strategist for equities in the U.S. I mean, there's, I guess, two schools of thoughts, whether this is a deep, ugly recession even in the U.S. or whether it's shallow, we can get by, but we're going to see a readjustment. Which one is it?
I don't think it's going to be that bad. Ultimately, I think what's happening at the moment is that mortgage rates are at a level where very few people can afford to move home. So you're going to see a very sharp decline in home sales, which is already starting to take place. With that, you then start to see fewer homes getting built, and then some job losses in the construction industry, which tends to then lead to further job losses elsewhere in the economy. And so I think that will cause a moderate recession. But the good thing in the US is that only about 4% of people are on variable rate mortgages. So if you just stay put, you can still afford the house you're in, you just can't move. So I don't think it gets that bad in the US. In the UK, it could get worse. If rates stay as high as they're predicted to stay, then I think the UK could have quite a deep recession. But I actually think they're going to cut by more than the market expects.
So, Mike, in the US, first of all, how do you position yourself? Does duration still look attractive?
I think it does. I think that duration looks attractive anywhere north of 3%. My best guess is that by the end of 2024, the Fed will have cut rates to about 2.5%. Okay. And that's a bit lower than the market's pricing at the moment.
The BOE is probably the most interesting one because it's where we could see maybe the biggest policy mistake. I mean, how do they get into this Thursday?
It's frankly the trickiest one for them because, you know, they've got all these strikes going on at the moment. There are risks that you see wages really pick up somewhat on the back of that. So they're in a very difficult position. But I ultimately think the UK housing market is in a lot of trouble if interest rates go up to 4.5% and stay there for the foreseeable future. So I think maybe they do get to 4.5%, but then they're going to have to cut by more than the market's pricing. The notion that they'll still be at 3.5 by the end of 2024, that seems to me the housing market would be in a lot of trouble by then. So I think they need to cut more. So
sorry, Mike, the trajectory is what they're actually aggressive now and then cool off in 2023. I mean, that would be a big gamble.
I think they're aggressive now, and then in 2024, they cut by more than is priced.
2024. Yeah, that makes sense. What do you do then with UK assets right now? And there's such a huge difference between the FTSE and FTSE 250.
Yeah, and that's obviously partly been helped by the fact that commodity prices have done very well this year, and it's a big part of the FTSE 100. Also, of course, sterling's been very weak, and 80% of the revenues for the FTSE 100 come from abroad, so that helped as well. So the big risks for the UK market next year are that sterling goes up a bit, and that would hurt the translated revenues. I'd personally be neutral on the US. I think there's good value in US value stocks at the moment.
Mike, when you look at, I guess, to China and further east in general, it doesn't seem that they can get it right. It's either, look, they have to stop COVID zero, or analysts worry that then there's too many people ending up in hospital. How do you play China?
I think there's everything we've seen in the last few weeks suggests to me that they're going to try and move past COVID. It will be interesting to see what that means. It was interesting to see the people, the head of the health authorities out there coming out and saying, actually, maybe if Omicron does rip, it's not that much worse than flu. We'll see if that's true or not. But we know, of course, in the West that Omicron, even for people unvaccinated, has been less bad. So there's a chance that it's not as bad as some people fear if they do let COVID spread. Of course, if they do have to have further lockdowns, then I think that's just going to encourage them to ramp up the vaccinations. And that's the most encouraging thing for me, the fact that they're now being a lot more serious about trying to get the over 60s vaccinated, because that's obviously the way past this in the medium term.
But, Mike, I mean, a number of questions actually on the back of it, and how difficult is it to model what the economy does and their appetite for energy and commodities?
Yeah, I mean, ultimately it's going to come down to when they get through COVID, because the economy is going to be weak until they do that. But I do think that there's an increasingly high probability that by the end of 2023, China is no longer worrying about COVID, either because they managed to ramp up the vaccines, that's the base case, or maybe they let COVID go and it doesn't put that many people in hospital because Omicron's more mild. Either way, I think by the end of 2023, China can reopen, and then they can probably do a bit more stimulus, which might boost things like metal demand.
So at the moment, and we look at some of the commodity currencies, I'm thinking Australia, New Zealand, and others, are they a good value? Like if you look at the markets in 2023, and we're 2 weeks away, or 2 or 3 weeks away from that, so it's a good time as any to have a look. What do you buy?
Hard to say on those currencies, because you've got, I think, places like Australia and New Zealand are suffering from higher interest rates and pretty high household debt to GDP ratios. So I worry slightly about the housing markets in places like that. That's the sort of downside. Of course, Australia benefits from high commodity prices if China benefits as well. So I think they're kind of offsetting. I wouldn't take a big bet on it. I mean, currency-wise, it's always very hard to say. I do think there's a chance that if by the end of 2023, the market is starting to look through a recession, that could start to bring the dollar down a bit.
Okay, the dollar, what if the dollar doesn't go down? So what does it mean for emerging markets?
I actually think it's going to be more important for the big emerging markets what happens with China. So if we get this China reopening, then I think EM as a whole are going to have a pretty decent year. But some of the smaller emerging markets could struggle in a world where the dollar goes higher.
ECB, we haven't even touched on ECB. I mean, it's going to be a busy Thursday. What does ECB, like some of the challenges of Christine Lagarde, I mean, they're huge. We also saw energy prices in certain countries go up like 30-fold.
Yeah, I mean, I think Europe's going to go into a recession on the back of high energy prices. I think most people know that already. Right. I think the ECB, though, the market pricing there looks to me more realistic than it does for the Fed or the BOE, because I think that Europe can actually cope with interest rates at 2%, which is broadly where they're expected to be by the end of 2024. So let's say they go to 3 and then back down to 2. That seems kind of realistic to me.
Okay, so you don't buy euro. I mean, are there any bonds in Europe that could look attractive as long as the ECB stays put?
I mean, I think they're kind of broadly fairly priced. When I look around the UK, Europe and the US, the potential for more cuts than are priced is in both the US and perhaps to a slightly lesser extent in the UK. But I'd be inclined to be overweight UK and US duration and just neutral in Europe.
Okay, neutral, so there's not an Italy play versus versus bunds or something like that.
It's hard, isn't it? Because spreads haven't widened as much as they sometimes do in recessions. As I say, I think the big question at the moment is ultimately, does everyone know this recession's coming? Almost everyone I speak to does. Listening to your channel, it suggests most people do. So I think, it's probably pretty well priced in, but things like Italian spreads are not pricing it to the extent that they sometimes have. Okay,
if you don't know if a recession's coming, do watch Bloomberg. Mike, thank you so much. Mike Bell there, global market strategist at JP Morgan Asset Management. Coming up, the UK's big chill. Power prices hit record levels as freezing temperatures cause a surge in demand. We'll have plenty more on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK economy grew faster than expected in October. This as businesses recovered output lost following the extra bank holiday for the Queen's funeral. Now, GDP expanded 0.5% month on month. Estimates were for 0.4%. Now, for more on this, but actually the bigger story, which is energy prices, we're joined by Bloomberg's Lizzie Burden. So, Lizzie, not huge surprises in the data.
No, ever so slight gain, beat, I should say, 0.5% month on month in October, driven by retail and wholesale trade. And as you say, the data was sort of muddied by the Queen's funeral, which meant there was a national bank holiday in September. So this is a bounce back from that. It doesn't really move the dial for the Bank of England. However, it is the recession fears that mean we could see a four-way split at the meeting. That's according to Nomura and Bank of America in their notes recently, because you could see the doves like Silvana Tenreiro and Swati Dingra voting for 25 basis points or even no hike at all. And then if you did have a four-way split, it would be Andrew Bailey, the governor, who'd have the deciding vote.
Yeah, and that's interesting because he's kind of been on the fence and saying exactly the way he would vote. Talk to me about energy prices. So yesterday, between 5 and 6 p.m., there was like this crazy hour. We don't have enough wind. And so the megawatt per hour went up by like £2,500.
Exactly. And that's an all-time high. It's today, later on, that we're expecting to see really strong energy use, because we're going to have to heat our homes in this snow. Freezing temperatures really not what you want when people are struggling with their energy bills. But if you can afford to have the heating on, you might want to work from home if you can work from home. It's a really difficult day. So as you say, the EPEX spot exchange for the 5 p.m. hour has cleared an all-time high, more than £2,500 per megawatt hour.
I mean, it's crazy. That's, I think, 45 times the average overall. What does it mean? I mean, we're looking at house prices declining. Like the UK economy seems to be in worse shape than most European economies.
And throw in the strike action that we're seeing, and the government is now considering having to bring in the military and civil servants to cover for the air and seaport workers. There's an emergency meeting of COBRA this morning, which is called when there's a major national disruption or emergency. So it's a very, very difficult moment. The nurses, I should say, in particular, 100,000 of them could go on strike on the 15th or the 20th and the 20th of December. They want almost a 20% pay rise. So it's eye-watering. Very, very difficult moment for the government.
Yes, we know that, as you're saying, they're drafting in some of the military to deal with the strikes or even border control. How are pay negotiations going with government?
Well, the reason is because the army itself, of course, can't go on strike, so they are the last resort. If you look at it, at this 20% pay rise, the nurses' argument is, you clapped for us, so surely we deserve a real terms pay rise at this moment. But the government has to say, you know, it's pumped billions of pounds into supporting people with their energy bills. It can't, it says, afford to give double-digit pay rises, which would add to inflation. The converse from the unions is to say that there's this gap between public sector wages and private sector wages, about an average of 5% versus 6.8%. And in the public sector, you don't have a wage price spiral because they're not charging higher prices as a result.
So, Lizzie, we mentioned BOE. I mean, Thursday's a big day. We have, of course, ECB and BOE with that possible split vote, giving Andrew Bailey the kind of the final say to unlock it. What does that mean for sterling? Like, how worried are they about the strikes, the energy prices, but also a possible protracted recession 2023?
Well, it's obviously not a good look for sterling. I would say that the strike action isn't playing into it that much, because if you look at the impact of the strikes on GDP, actually, it's marginal. But yes, the recession fears are what's driving the negative outlook for the pound. And this is really what's driving the potential four-way split on the committee. It's Swati Dingra and Silvana Tenreiro thinking, if you're thinking about the 18-month lag in monetary policy, this is when we could be in the depths of a recession. So that's precisely the moment when you're not going to want a big hike taking effect.
Great. Lizzie, thank you so much. Lizzie Burden there, our UK reporter. Now, coming up, there's a change at the top of Maersk. We'll hear from the incoming CEO, Vincent Clerc. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Maersk Chief Executive Søren Skou is retiring after 6 years ahead of the company. Now, he will be replaced by Vincent Clerc, the current head of the transport giant's ocean and logistics business. Well, we spoke to Vincent earlier.
After the couple of years of very high demand during the pandemic, we're seeing an inventory correction right now. We had expected that. We see a rapid normalization of freight rates. In the short run, they are likely to possibly undershoot a little bit for a period as our customers actually right now correct inventories and therefore move fewer volumes than what they normally need to from an underlying consumption perspective. So what we're doing here is really a strong focus on our cost base. Strong focus on offering the capacity only that is needed for the volumes that are moving today, and focus also on operational cost, continued focus on operational excellence in order to weather this difficult period. But I think what is important to remember is these inventory correction, they only last for so long. It's about hunkering down, making sure we get our basics in order, and the team is all over it.
Vincent, let me just unpack a little bit of that, because the details around the shipping rates, you said they're likely to kind of remain low for some time. Where does that take you into 2023? How much more downside to shipping rates do you expect to see? And as we face up to these recession risks, what are you seeing in terms of your customers, your clients, in terms of the slowdown in exports and global trade? We saw, for example, the data out of China with their exports looking softer. What are you seeing in terms of the detail on the data?
Yeah, so what we're seeing is clearly a demand going forward in 2023 and 2024 that will not be at the level, at the record level that we have seen in 21 and 22. Partly because demands for some of the commodities that were in especially high demand during the pandemic, like durable goods and so on, this has really abated right now and is normalizing rapidly. Exactly what this means from a demand perspective is hard to say at this stage. We're seeing this unfold. I think we see this inventory correction now. We expect it to last it through probably another few months before we see volume pick up again out of Asia and to align themselves more with what we're seeing as being the underlying consumption. Normalizing of freight prices, as you mentioned, has happened to a large extent, and they have already come to levels that are pretty critical. And we are therefore already taking pretty sizable measures to restrict capacity, to lower our cost base and make sure that we can weather this in the best possible way.
That was Vincent Clerc, the incoming Maersk chief executive. Now let's also get to your Bloomberg First Word News and COVID rapidly spreading through Chinese households and offices after pandemic rules were unexpectedly unwound last week, with hospitals struggling to deal with the surge in cases. Well, scenes of disruption are easily visible in Beijing, where anecdotal evidence suggests that the caseload is many times the government's tally. Now this, as a top medical advisor is quoted saying, the fatality rate from the Omicron variant is actually similar to flu. A major investigation into the bribery of European Parliament officials by an unidentified Gulf nation has led to the arrest of 4 suspects, including a lawmaker. Well, Belgian prosecutors raided multiple properties across Brussels on Friday. Federal judicial police investigators said they suspect a Gulf country of, quote, trying to influence the economic and political decision of the European Parliament. The U.S. will send a delegation to China in the coming days, following up on President Biden's meeting with Xi Jinping last month at the G20 summit. Now, the State Department says the visit is to, quote, continue responsibly managing the competition and to explore potential areas of cooperation. The visit will also prepare for Secretary of State Antony Blinken's planned trip to China earlier next year. And France and Morocco are to face each other in the semi-finals of the Football World Cup. The French beat England 2-1 after captain Harry Kane missed a penalty shot that would have brought scores level. Well, Morocco became the first African or Arab team to reach the semis, beating Portugal 1-0 to set up the match against France. That will be a pretty hotly anticipated match. Well, that's your First Word News. We're also getting this. Well, we're getting the markets. we always get the markets, but let me bring you up to date with what the markets are doing. Overall, the picture is not great, as we're expecting, of course, traders to be on edge ahead of central banks meeting this week. These stocks are declining at the start of a pivotal week for markets, with interest rate decisions due from the Federal Reserve, European Central Bank, and a host of peers. Coming up, we'll speak with Stanhope Capital Chief Executive Officer Daniel Pinto on creating one of the world's largest independent wealth managers. That interview is next, and this is Bloomberg. Central bank bonanza. It's a pivotal week for markets with no fewer than 11 meetings, including the Fed, the ECB, and the BOE. Stocks kick off in the red, the dollar up. Power surge. London wakes up to the season's first snowfall as heating demand drives energy prices to records. Meanwhile, the UK also braces for a prolonged series of strikes. And logistics change while the shipping giant Maersk names Vincent Clerc as incoming chief executive, taking over from Soren Skou after 6 years at the top. Shares trade lower. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, speaking of London, the London-based investment firm Stanhope Capital is extending its reach, announcing a merger with Luxembourg-based Arch Associates. Now, the tie-up will actually create one of the world's largest independent wealth managers. And to discuss this story and much more, we can talk to Daniel Pinto. He's chairman and chief executive of Stanhope Capital. Daniel, thank you so much for coming on. And you came on also on such an exciting day, not only for Stanhope, but actually, wealth in general. Is bigger better in asset management when you have, I guess, a confluence of also things that could be concerning for markets?
Not necessarily, but we felt that Luxembourg was a very important marketplace. Yeah. It has benefited greatly from Brexit. A lot of firms have set up shop in Luxembourg. Rather than starting from scratch in Luxembourg, we felt that merging with the top independent wealth manager in Luxembourg was the right move. Arch was created 12 years ago by 3 ex-bankers from Rothschilds. In the space of 10 years, they got to create the most prestigious independent wealth manager, managing about $2.5 billion. Yeah. And we knew them. We had worked with them for a long time because we're managing clients together, and we felt that it was a perfect fit. Right. That's why we decided to merge. I
mean, mergers in any space, but more so for wealth management, are always difficult because of culture, because of different DNA. What do you think your main challenge in putting the groups together will be?
Well, it's to create a platform that serves clients better. I mean, that's the top priority. It's not just about size, in response to your question about bigger, better. It's about being able to offer clients top-of-the-line investment management across asset classes and across the world. And when you are a big bank, you can do that because you have 50,000 employees and they are in all corners of the world. When you're independent wealth managers, it's more difficult. And as a result, we feel that having that strategy of growing organically, but also adding competencies and regions in a very selective way is the way to go. In the case of Luxembourg, they had a specialty in terms of providing family office services to their clients, above and beyond pure wealth management services. We felt that it was very additive to what we're doing for clients. When we made, the merge, when we merged last year with the American firm Forbes Family Trust, which was at the time managing about 11 billion, the spirit was different. It was not about family office services. It was about adding that US expertise to the range of services that we're offering to our clients.
Daniel, overall, are client demands changing because of volatility and because of the new challenges as inflation goes up?
Absolutely. I think that clients are more demanding. I think that clients require more expertise and more depth on the part of their service providers. I think clients are, increasingly interested by a broader array of asset classes. Right. It's not just the, stocks and bonds, the 60-40.
Crypto.
well,
we
didn't touch that, but it's no longer the 60-40 portfolio. No. It's about investing in private equity. It's about investing in real estate. It's about investing in alternative assets and doing that in the most professional way possible. Yeah. And for firms like Stanhope, it was very important to offer that to our clients.
Do you think the 60-40 will ever come back? And actually, do you worry private equity? I mean, if we see liquidity concerns in certain parts of the market, including treasuries, what does it mean for liquidity in private equity?
I'm not as concerned as, a lot of people are increasingly concerned about private equity. I think that you might see returns in private equity come down a bit. But come down from where? I mean, the average private equity performance in the world of buyouts in the last 20 years has been about 15% per year. That's the average. If it goes to 13%, are investors going to be very disappointed? I don't think so. Okay. So I think it keeps a place in client portfollios. Very important one.
And 60-40, does it come back? I mean, look, 12 months ago we're saying it's dead, that's it, bye-bye. And actually in certain parts, it could come back in the next 12 months, maybe?
I'm absolutely convinced it will come back.
Okay.
Not just the 60-40. As I said, it's important to be properly diversified with private equity, etc. The bonds are going to come back. Yeah. I'm not saying I'm bullish on bonds, but bonds are going to come back at the point where we reach peak interest rates in the US, which probably will be in Q1. And I think, in Europe, we are going to reach peak interest rates probably also early next year. At that point in time, investors in bonds will become a bit more interested because the perspective of bonds, of interest rates coming down probably in 2024, not in 23. In 2024, will make it perhaps more palatable to invest in bonds. So I'm not saying to you one should be dogmatically attached to 60-40, but the principle of being properly diversified and having a good portion of your portfolio in equities, but also a good portion in bonds, I think is still very valid.
But Daniel, I mean, peak interest rates, okay, by the Fed, are you actually expecting them to cut? And does it mean that the recession could be protracted but quite shallow, or is it going to be an aggressive recession?
So we expect a shallow recession. We're not in the doomsday camp. We expect it to be a shallow recession. We expect interest rates to peak at 5%, probably by the end of Q1 next year. Maybe a bit less, but probably 5%. And when that happens, I think it will reassure the markets because it will give a direction about what's coming in 2023. They will see that corporate results are not as bad as people predict. You now have a lot of people analysts revising their expectations for corporate earnings next year, coming up with dire scenarios of minus 10% for corporate earnings. We don't believe that.
Mainly energy, right?
Mainly energy. We don't believe that. We feel that corporate earnings are probably going to grow by 3 to 5% in the US next year, which would not be the end of the world, and which would mean that current valuations in the equity markets are not bad, actually. No. We are trading below, in terms of price-earning ratio, market multiple, we are trading below the average of the last 25 years. And even more below in Europe. The US is kind of in line with the average of the last 25 years. In Europe, we're trading on a PE of 11 against an average price-earning ratio of about 14.5 over the last 25 years. Depends what you expect for earnings next year, but we don't believe that it's going to be a catastrophe as many people predict.
So we have Bloomberg Intelligence, and our chief U.S. market strategist came on this morning, and she was basically saying that, I mean, it's a similar scenario, but it would still take, looking at her metrics, 3 years to have a new record on the S&P 500. I mean, that feels like a long time away.
Yeah, I'm very careful about this kind of predictions because people were gung-ho in 2020 and 21 as if markets were going to carry on rising forever. And now they are predicting doomsday. And so these oscillation between extremes, I think, is not... The reality is probably somewhere in the middle. You will not see in the equity markets the kind of performance we saw in 21 and 20. But you might see a high single-digit performance for equity markets next year. And that makes it worth investing in equities next year.
Daniel, we'll get back to markets in a second. But when you look at wealth managers, are there too many? It seems like we used to be overbanked in terms of banks, and now there's just so many wealth management companies. Are you expecting more consolidation?
It seems to me you have too many of the wrong type. Which is that you have two extremes in the world of wealth management. One extreme, you have all the big banks they have all the resources in the world, financial and in terms of human resources. But sadly, still a lot of conflicts of interest. They are advising clients, but at the same time selling to them, and that's an issue. That's one extreme. At the other extreme, you have hundreds of independent wealth managers who do not have the conflicts typically, but do not have the resources. What we've done with Stand Up Capital is to try to take the best of both worlds. Creating a group that has 160 employees, 8 offices, covering the world and covering all asset classes, so resources, but at the same time being on the side of clients, being properly independent and not having the kind of conflicts of interest that you find in the industry today.
Is this just the first of many M&A deals to come? From you? How much bigger do you want to be?
Not many. I don't think that we are in a rush to buy firms. I mean, that's not the approach. Obviously, we are the obvious consolidator in our space of independent wealth managers, obvious, because we have become one of the largest in the world in our space. But it's not size for the sake of size. As I said, it's size for the sake of serving our clients better.
All right, Daniel, thank you so much. That's very clear. We'll get back to Daniel Pinto and talk a little bit more. Also about the UK, the new regulation, of course, are London-based, so how he sees the future of the City of London. Coming up, Chinese officials are further downplaying the risks of COVID-19 as restrictions are eased. We'll look into that story a little bit later in the program. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, last week, the UK set out a package of post-Brexit reforms intended to boost the City of London, with changes including relaxing ring-fencing capital rules to lighten the burden on smaller banks. Now, let's talk to Daniel Pinto. He's Chairman and Chief Executive of Stanhope Capital. And Daniel, thank you so much. First of all, sticking around. You were also, you're a city grandee as a compliment, but you also, 10 years ago, you were telling me, basically looked into or established a think tank looking into regulation for the City of London and what the City of London needs in the future. Like, where are we? Finally, we have a government that's, taking aim at this, but it wasn't the Big Bang 2.0 that we were expecting.
First of all, we are delighted to see the government pay attention again to the city after 10 years of city bashing. I think that the government understands that the city on its own is very important for the UK economy. It's about 8-9% of the country's GDP. It's 600,000 jobs. That's great. But even more importantly, the government understands that you cannot have a flourishing economy without a flourishing city. And they are trying to come up with ways of unleashing this vital energy that you find in the city and in the economy. And regarding the plan that was released at the end of last week, I think there are a couple of things to say. The first one is that there are good aspects, and the best aspect of the plan is trying to make SMEs, small and medium-sized companies, the very center of the UK economy. And you can achieve that both by ensuring that private equity money flows in the direction of growing companies, and by making sure that the public markets remain friendly to these high-growth companies. How did they achieve that? Solvency II, which is a way of relaxing the rules affecting pension funds and insurance companies, enabling them to invest more in green energy, etc. That's great. How did they achieve that as well? With potential reforms to MiFID II, which was, as you know, an EU rule. Some aspects were very positive, other aspects were detrimental. For example, the collateral damage of MiFID II is that research on small and mid-cap stocks kind of died, literally died. And so if we are going to make public markets more welcoming to small and medium-sized companies, we have to make sure that there is equity research provided on these companies. And that's what it's achieving. There are some negative aspects to the plan that came out last week.
Daniel, could they have done more in general? So I want to know about the negatives, but also when you look at, the bonus caps, the Collins that they haven't done. I mean, these are things, ring fencing could have been done actually 3-4 years ago.
Right. So I slightly disagree with some of the measures that were proposed in that plan, which again had positive aspects, but I disagree with cancelling ring fencing. I think ring fencing was a very good rule. There was a report that came out after the great financial crisis, as you know, the Vickers report, that came up with this proposal of ring fencing the balance sheet of the deposit-taking side of banks and the balance sheet of the riskier investment banking side of banks. That was a very good rule. There is absolutely no reason to come back to it. And I think that probably the government is spending too much time speaking to heads of banks and not enough time speaking to SMEs and independent asset managers, because we would not have proposed this kind of rule. Similarly, cancelling the senior manager regime is a mistake. It was a very good thing to make heads of banks more responsible personally on what the banks are doing.
But sorry, if we go back to ring fencing, and this is an outlier call, I haven't really heard this actually from many people saying that you would have kept the ring fencing. Is it because it puts the smaller, I guess, banks at a disadvantage if the big banks don't have to do? Because I keep on hearing that actually ring fencing wasn't really necessary because of the capital requirements.
I don't agree. I think that ring fencing was a way of preventing banks, big and small, from using deposits to pursue riskier activities. That was an obvious change coming out of the great financial crisis, which, by the way, was triggered by banks. Let's not forget. And I think that you didn't need to reform that in order to create growth in the UK. You didn't need to do that. The problem, again, with the perception of the city is that the city, in people's mind and in government's mind, is still very much about big banks and FTSE 100 companies. The city is something else. The city should be about SMEs. It should be about everyone. And I think that promoting growth is about paying attention to SMEs and that side of the economy.
Daniel, when you look at, we talk a lot more about Brexit. What does the city become post-Brexit? And are these measures, rightly or wrongly, to try and reverse some of the negative impact of Brexit on the city?
Well, the city has adjusted to Brexit. I think it's water under the bridge. The big companies, the big banks had no issue whatsoever because they already had subsidiaries on the continent. The independent wealth managers typically have expanded on the continent as well. As you know, we have offices in Paris and Luxembourg, etc. So I think Brexit is kind of neutral from that perspective. The one thing about Brexit is that it is creating a bit of a tension, if you will, between the regulators in the UK and in Europe. It's very hard to imagine that we can ignore the regulatory framework in Europe when, in fact, most of our financial services sector is also driven by trade with Europe. So I think we have to find the right middle ground between reforming what can be reformed. I gave you an example, which is MiFID II, but keeping, on the whole, the body of regulation that we had established in conjunction with the EU when we were members of the EU.
So we have to also get back to the markets. You're pretty positive about earnings expectations in the US and think basically the market have gone too far. Does everything rely on whether China successfully reopens? Is this the biggest unknown, and what do you think?
It is one of the unknown, and I don't think the fate of markets rely on that. But it's an important element. I do think that the current government and President Xi understood over the last 2 weeks that there was a turning point, actually, in terms of social peace in China, in the sense of people being locked up for 3 years was not sustainable. And I do think that in spite of the rise in infections in China, they will keep reopening. And I think that it's a positive for GDP growth for next year.
Daniel, thank you so much for coming on. We'll have to get you back on very soon to talk a lot more also about the City of London. Daniel Pinto, their Chairman and Chief Executive of Stanhope Capital. Now let's get straight to your Bloomberg Business Flash. And Microsoft has agreed to buy a stake in the London Stock Exchange Group, giving it a 4% equity holding. Now, the U.S. software giant will acquire shares held by a consortium made up of Blackstone and Thomson Reuters. The stake is part of a broader 10-year partnership to help the LSE owner develop data analytics and cloud infrastructure. Twitter will relaunch its Twitter Blue subscription service on the web on Monday for $8 per month. The company says Apple's iOS users will also get access for $11 per month to subscriber-only features, including the blue check mark. Well, the relaunch of Twitter Blue was suspended in November due to a wave of profile impersonations. And Amgen is said to have agreed to buy Horizon Therapeutics at a valuation of about $26 billion and what would be its biggest ever acquisition. The U.S. biotech giant offer is at a premium to Friday's closing price of about 20%. Potential buyer Sanofi backed out of a deal on Sunday after takeover reports pushed Horizon's market value to $22 billion. That's your Bloomberg Business Flash. Coming up, Beijing asking COVID patients with mild symptoms not to call the medical emergency hotline. So we'll have plenty more on the country's reopening risks. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, top Chinese officials continue to downplay the risks of COVID-19 as cities across the country ease restrictions. Well, Bloomberg's Rebecca Chung-Wilkins now joins us. So, Rebecca, what's the latest?
Well, China's top medical advisor sort of emphasizing to people that COVID is just as serious, or no more serious rather, than the flu. And that's been echoed by a lot of state commentary, essentially trying to downplay the severity of the virus and even urging people to stay at home if they don't really have symptoms, to recover and rest at home. But what we're seeing on the streets, and particularly the focus here is on Beijing, is a lot of the disruption and some of that chaos that many countries saw when they first reopened, when they first hit by COVID infection waves. So long queues outside hospitals, people struggling to get access to the medical care and medicine that they need, as well as signs of stockpiling and things like that. So quite a disruptive sign in Beijing. And although the case numbers themselves seem to be dropping, it's really being attributed by most people to a fall in testing, because in actual fact it does seem like infections are spreading very, very quickly through the capital.
So what's the also potential significance of the China reopening its border with Hong Kong?
Well, I mean, the opening so far as we know it, local media reporting, it would be a sort of pilot scheme that would essentially allow Hong Kong residents to cross back into mainland China. And it would be very, very significant. That border has effectively been shut since February 2020. It's been an extraordinary long time for a border that is normally one of the most porous in the world. Residents typically crossing every day. Back in 2019, there were more than 200 million crossings. So it is sort of really pivotal to the role that Hong Kong itself also plays as this gateway between mainland China and the rest of the world.
Thank you so much, Rebecca Chung-Wilkins, there with the very latest on China. In the meantime, stocks are actually dropping. Central banks keep traders on edge. It's certainly a big week for central banks. We not only have the Fed, but we have the ECB and the Bank of England. European stocks declining at the start of a pivotal week, of course, for markets. Interest rate decisions, as I was saying, are due from, I think, 11 central banks overall. Investors looking for firmer clues on how far and how fast central banks will tighten monetary policy from here as recession fears resurface. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York, Anna Edwards here in London. The other thing we're watching out for is, of course, the 24 hours of hike that end the year of fighting inflation. So we're not only looking at the whole week, but it's really 24 hours. The U.S. Federal Reserve on Wednesday set to raise its key rate by 50 basis points. And then a day later, we have the European Central Bank, the Bank of England, likely to follow with half-point moves. Higher borrowing costs are also in the cards with Switzerland, Norway, Mexico, Taiwan, Colombia, and the Philippines. This is Bloomberg.
This is a very challenging economic situation here and across the world, and it will get worse before it gets better.
These stagflation problems that we've seen this year, they're not going to go away anytime soon, and there's going to be a nasty inflation sting in the tail with China's reopening.
I think there's a growing coming together that we probably are going to make more progress on inflation than many people expected, but it's because the Fed is going to do what's necessary.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Focus on the Fed. The central bank is expected to downshift this week on interest rate hikes, but inflation data out Tuesday could complicate matters. Power prices in the UK jumped to a record. Freezing temperatures cause a surge in demand, while a drop in wind generation leads to a supply crunch. And two multi-billion-dollar deals making news. Bloomberg's learned that Amgen has agreed to buy Horizon Therapeutics at a $26 billion valuation. Meanwhile, Microsoft is taking a stake in the London Stock Exchange Group. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, it really is a busy week to bring almost to a close this year.
Yeah, I think we might be able to call the year over by the end of this week once we've gotten the rate decisions from the Fed, the ECB, the BOE, and of course we've already gotten that inflation print coming up tomorrow. So it's a lot for the market to consider. In Asia, they also are considering, on top of all of that, the trajectory of COVID and COVID restrictions in China. Of course, we have seen an easing of those restrictions, but the result of that is that cases are surging and leading unprepared hospitals to be in a bit of a difficult position in China. So that really seemed to drag on risk sentiment in Asia overnight. The MSCI Asia Pacific Index as a whole down about 0.9%, but it was Chinese stocks listed in Hong Kong that really underperformed. They were down by about 3%. At the same time, in foreign exchange, the Chinese yuan is weaker against the US dollar. Still, we're sub 7 on offshore yuan to the dollar, 697.56 where we trade at the moment. But again, that is a little weaker on the day. And then, of course, in the bond market, that is really where you see traders trying to grapple with and anticipate what we are going to see over the course of this week from 11 central banks making decisions. And we did see upward pressure on yields in the Asia Pacific overnight. In Australia, that 10-year yield up about 9 basis points to 3.38, Matt.
All right, that's interesting. Yields coming down here in the U.S. and pretty much everybody is bullish on the bond market, with the exception of Wells Fargo. Eric Nelson was on from Wells Fargo with John Farrow on the Open Friday, and he said he sees yields going to between 425 and 475. Now, that's contrarian. Everybody else on the street thinks that pretty much everyone else thinks that we've hit a peak already in yields with the 4.25 that we saw last month or 2 months ago now. Today we're trading down a little bit to 350, 397 as investors buy this debt. Investors are also buying U.S. futures right now up just about 0.2%, but the trend is up. If you look at a graph of futures, you'll see the curve goes up and to the right. So 39.74 is what we're looking at there after we finished the week down last week. And then, speaking of down, NYMEX crude off another % today to 69 cents, down to $70.33 a barrel. It's the lowest level we've seen on crude since, I think, December 20th of 2021. So it's been almost a full year since we've seen a drop this, or a level this low, I should say, on oil, which is interesting if China's reopening. It does look like the world is, or investors are more concerned about a global recession. Bitcoin right now down at 0.9%, but still a little changed around 17,000 as we've been seeing for the last few sessions, 16,961, so continues to hold steady. Anna, what do you see in Europe?
Yeah, more on crypto later in the hour then, Matt. This is the picture in Europe. And actually, I mean, it's negative, but it's better than it was. To Matt's point there about how futures are trending higher for US equity markets, well, the same is true of the European session. As those US futures recover a little bit, we are seeing that help Europe to gain a little away from earlier lows, at least. So the FTSE 100 down just 0.1%. The CAC 40 almost flat. The DAX down 0.1%. That said, all sectors are still in negative territory here in Europe. So it is pretty broad-based. But we're really trying to play catch-up with Wall Street. That late sell-off we saw on Friday as a result of the PPI data, just spooking investors a little bit, setting us up this week for the CPI. More on that in a moment. It really is a busy week ahead. Let's have a look at some of the assets we picked out from Europe to mention today. Matt was talking about WTI. The same applies here on Brent, 75.29, down another 1%. This is one of the sectors in Europe that is in negative territory today, the energy space. So energy producing companies trading lower today, partly because of this move lower in the oil price. And to Matt's point, maybe recession fears are dominating thinking rather than the reopening themes around China. The pound at 122.81. It has recovered a lot from that 103 level, but it is possibly going to be a volatile week. We have a Bank of England meeting this week. We have a lot of central bank meetings this week, some 11, in fact. Could we see a four-way split at the Bank of England? Could there be votes for hold, for 25, for 50 and for 75 from those 9 policymakers? That is the question. London Stock Exchange Group, then, that stock up by 3.7% as Microsoft takes a 4% stake. Of course, LSE Group now owns Refinitiv, which competes in some places with the owner of Bloomberg Media, so we should mention that. But interesting to see as it is increasingly a data company doing this kind of deal, and board members from Microsoft going onto the board at London Stock Exchange Group. This is Christian Hansen, which is a specialty chemicals business, up by 20% in Denmark on this M&A Monday, as we see the enzymes business that is Novozymes, another Danish business, coming in to buy it. Are they paying too much? That is the concern that Credit Suisse has, and that is reflected in the Novozymes share price, which is substantially weaker, Matt.
All right, so a heck of a lot going on in markets, and it's not even 5:15 on a Monday morning. A big week lies ahead for the world's biggest central banks. Rate decisions are due from the Federal Reserve, the European Central Bank, and the Bank of England. The Fed decision on Wednesday is coming after crucial U.S. inflation data, the CPI, that's due out tomorrow. Joining us now for more is Valerie Teitel, our markets reporter. So, Valerie, what will drive markets this week?
Hey, Matt, good morning to you. Okay, I've got 3 things which I think are going to be key for this week, and it's all the data coming out of the U.S. and the Fed. First, it's CPI. I really am interested in this core services ex-housing component, because in the last speech we heard from Powell, he took inflation and broke it down into 3 parts. It's goods, it's housing, and then it's core services ex-housing. He said that we had progress on the first 2, but said that this one is a little bit more muddled. And more importantly, this is the most important driver of inflation going forward. So on Tuesday, I'm really going to be looking at that component. Next is the Fed's SEP. This is their summary of economic projections. This includes their forecasts for unemployment and for rates. I'm really going to be focused on the 2023 dot. This is what most people think is where the Fed is trying to guide us on the terminal rate for next year. It was 4.6 at the last meeting. He told us it's headed higher in his last press conference. But how much higher? 5, 5.25, 5.5? What are we looking at? The market is currently pricing around 5. I think any shock about 5.25, 5.5 will really turn the equity market sour. Lastly, any comment on the loosening of financial conditions from Powell? This was notably absent in his Brookings speech. He really failed to push back on the equity market rally, especially that we've seen since the bottom just a few months ago. And in my next chart, I want to show what the S&P is battling with here. It's really having a tough time cracking the 200-day moving average. This is something that it really failed to test during the last pivot mania craze and bear market rally. But look, we had some decent analysis on the Bloomberg terminal today that said in the last 6 CPI prints, the S&P has moved an average of 3%. We are just 3% shy of the 200-day moving average, so we could really, if it comes in soft, we could really end the year above this mark, which I think would be key for driving risk into next year.
Okay, Valerie, thank you very much. Bloomberg's Valerie Teitel. I'm taking notes. 3 very important points to watch when it comes to the data and the Fed later on this week. Now, rare snow covering London this morning, with the Arctic weather testing Europe's resiliency during the energy crisis. Well done if you got into the office this morning. Well done if you've got your at-home setup sufficient that you didn't need to battle with the weather. But UK power prices jumped to record levels, but Europe's natural gas prices have actually slumped this morning. Joining us to discuss all that's going on in energy markets, Rachel Morrison is with us from here at Bloomberg. Rachel, good to have you with us. So is the UK going to have enough power tonight? That's one of the questions that markets, I suppose, have right now.
Yes, looking at this evening from about 5 p.m. during what we call the tea time peak, the supplies do look quite short, which is why National Grid has asked a reserve of coal-fired power stations to get ready to generate this evening. So that's one of the tools that they knew that they needed to have ready for this winter. And because it's cold, as you mentioned, demand is spiking, and because wind generation is almost nothing, it looks as though National Grid does need to use some of those tools that it has to make sure that the market is balanced and that we'll be able to keep the lights on this evening. They say it's looking okay. They've got everything that they need, but prices are extremely high for this evening. So the market is obviously still seeing that there's a bit of a problem.
Well, of course, to achieve that balance, Rachel, it's not just about bringing demand down. You also, in theory, would like to see supply moving higher. When will this supply crunch end?
Well, we know that the wind is going to pick up, possibly tomorrow and then throughout the week. But the weather's going to still stay cold, so we're still going to have a lot of demand. But even with a bit of a pickup in wind, I mean, it really is extraordinarily still here today. That will help the situation. So we do think it's mainly tonight, this evening, and then the situation improves. However, there could be more incidents like this throughout the winter at the same time when the weather's cold and the wind drops. That's the kind of bad combination.
All right. Thanks very much for that. Rachel Morrison there joining us on the telephone, talking to us about energy prices, which are expected at tea time today in London to hit an all-time high. Now, in deals news, Bloomberg's learned Amgen has agreed to buy Horizon Therapeutics at a valuation of about $26 billion. If approved, this would be the American biopharma company's largest ever acquisition in a difficult market for deals. Aaron Kirschfeld, Bloomberg executive editor for Global Deals, joins us now. So a lot of M&A news to kick off the week, Aaron, and this $26 billion deal is a big one.
Indeed. I mean, we were preparing for the snow and strikes this week and thinking we could focus on that, but actually we were extremely busy on the deals front. We knew that the Horizon Therapeutics sale was coming to a head, that it was down to Amgen and Sanofi, the French drug maker. But in a surprise announcement, Sanofi announced that it was dropping, and that left the door open for Amgen to seal a deal. And now our sources have been telling us and other media that they're nearing an agreement, could be announced as early today, and it's a whopping $26 billion deal.
Yeah, and a nice 20% premium to the closing price of Friday for Horizon, which is up about 13.6% in pre-market trading this morning. And of course, it's not just that merger or deal on this Monday we have to pay attention to. There's another one, Microsoft agreeing to a 4% stake in the London Stock Exchange. What can you tell us about that?
Yeah, when I saw that headline, I had a bit of a heart attack because I thought, oh, is Microsoft buying LSE? But actually, they're just in quotation marks buying a stake, still $2 billion investment. And I think it's more about a cloud partnership. They're looking to team up as LSE, as mentioned before, is kind of building out its data analytics, its cloud presence. So Microsoft, as kind of the long-term partner, will invest. So it shows, obviously, the two will be working very closely going forward. And it was one of, I'd say, almost half a dozen deals announced this Monday.
Yeah, absolutely. A lot to keep us busy on this Merger Monday, then. To keep you busy, certainly. Aaron, thank you very much. Aaron Kirschfeld, Bloomberg's executive editor for Global Deals, with the latest on a range of sectors there. Coming up on this program, we'll talk to Christian Keller, head of economics research at Barclays. How is he approaching this critical week ahead? And on crypto, Reeve Collins joins us, former co-founder and CEO of Tether, who's now co-founder of SmartMedia Technologies. We will talk about what we can expect from the Sam Bankman-Fried testimony about where stablecoins go from here. Plus, Ghosn's daring escape cost his extraction crew their freedom. Read more about the father and son team in today's Big Take story. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. We are looking at a fading S&P 500 premium over the 10-year yield. The earnings yield minus the 10-year yield falling here. Now, it's interesting. We heard Wells Fargo last week forecasting a possible 475 on the 10-year. That is, of course, a big outlier in terms of forecasts on the street. And pretty much every strategist has come out and said earnings are going to get hit, even if we don't go into a recession. David Costin from Goldman Sachs says the margins are going to get hit next year, so earnings expectations need to come down. Joining us to talk about this, Ven Ram is Bloomberg cross-asset strategist. Ven, it seems like every strategist we look at is coming out with a note saying we're going to come down to 36, 35, 3,400 at the end of the first half and then bounce back to 4,000 or 4,000 and more at the end of next year. What are you hearing?
Morning, Matt. I agree with the initial part of what these strategists are saying, that, you know, it's going to fall down to 3,000 plus, around 3,000 levels, because at the moment the markets are 95% optimism and 5% realism. And I think that paradigm has got to shift. I mean, the Fed is going to keep going on rates because okay, the economy is going to slow. Yes, we know that. But what we don't know is how much inflation is going to come down by. Yes, inflation may slow, but is it going to slow to 2%? That the Fed is going to take its foot off the pedal and say, okay, let's accommodate the markets now. I don't see that happening. And therefore, I think that stocks have more room to fall.
Okay, so you think we're too optimistic on stocks. Good to see you, Ven. Let me ask you about the trade-off then between stocks and bonds. I spoke to the CIO at Coutts earlier on, Alan Higgins, who was saying to me, yes, he can see arguments why people are saying, therefore, you get into bonds. But he says maybe there's going to be limited appetite for bonds when they yield what the 10-year is 3.53%, when you compare that to what you get on cash right now.
Absolutely, and I think that, there is a case to be made for bonds, but I do think that, you want to make a case for bonds at the front end, because if you look at the 2-year yield, you don't take too much of a duration risk, and you're getting a pretty decent yield. Of course, the two-year maturity has got a bit more to sell off, but I think we are kind of approaching the top. So that is on fixed income, it comes down to how we are positioned and where on the curve we are positioned.
And finally, then, in foreign exchange, what about the dollar?
Morning, Kelly. I think that the dollar is kind of done its peak for the year. I think if you look at the Dixie index, we approach 114 plus levels. I don't think we are going to reclaim those levels, simply because if you look at inflation-adjusted yields in the US, I don't think we are going back to those peaks unless the Fed does a second round of increases next year, which, based on the baseline scenario, is not the central case.
Okay, well, we'll see with the step down this week. That's what's anticipated if they deliver that, and what comes with it, what language. Ven, thank you very much. Ven Ram joining us there with the latest on, well, in that case, stock markets, bond markets, the dollar, a host of assets. For more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog, hotly debating moves in markets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. A man charged in the 1988 Lockerbie bombing of a Boeing 747 that killed 270 people is in U.S. custody. He's been identified as a former Libyan intelligence officer. The U.S. calls the suspect a third conspirator in the attack, saying he helped build the bomb that destroyed Pan Am Flight 103 over Scotland. In China, COVID is rapidly spreading through households and offices after the country's pandemic rules were eased. That's led to turmoil in poorly prepared hospitals. Some facilities are struggling to find enough staff, and others are suspending non-COVID treatments. Germany's Chancellor Olaf Scholz will host a virtual meeting of the Group of 7 leaders today to discuss Ukraine's immediate needs. That's following Russian missile attacks on the country's energy infrastructure. Meanwhile, President Biden spoke to Ukraine's President Volodymyr Zelensky. The White House says the president affirmed the U.S. commitment to keep providing military and economic aid. It's a change at the top of one of the world's largest shipping companies. The CEO of A.P. Moller-Maersk, Søren Skou, is stepping down. He'll be replaced on January 1st by Vincent Clerc, the head of Maersk's ocean and logistics business. Clerc is taking over at a time when freight rates are drastically falling. And in the UK, the government is planning for military staff and civil servants to cover for striking rail, health, postal, and other workers. Strikes are planned for almost every day through the rest of the month. Workers are demanding pay hikes that keep up with inflation. It's the biggest wave of industrial strife in the UK since the 1980s. And of course, you put together the strikes with the current weather situation you are dealing with, Anna, and energy costs that are shooting higher. It is a very complicated equation for the UK economy, especially for the Bank of England as they look ahead to their meeting later on this week.
Yeah, so many uncertainties. I mean, I mentioned I spoke earlier to the CIO of Coutts, Matt, and he was certainly saying there could be a lot of volatility around the pound this week because of this lack of visibility about the UK. I mean, the cost of living crisis means there's an emphasis on the downside risks for the UK economy, but we still have double-digit inflation, of course, and many people think that that will remain for a little while. So could we see this four-way split then at the BOE? Will be interesting.
And you know, double-digit inflation that nurses have to pay in order to deal with their daily lives. If anybody needs a raise, if anyone deserves a raise, especially after what we've just gone through, isn't it the nurses? I don't want to get too editorial here, but, you know.
There was a phenomenon around COVID where every Thursday night in the UK, people went onto their doorsteps to clap for those who work for the National Health Service, as sort of coming together, if you like, at a time of need. And so, yeah, a lot of the services saying, if you clap for us, now you need to pay us. That's their argument. Of course, the government has other arguments to make around.
Well, they were chronically underpaid to begin with,
not making the inflation services, the inflation any worse, and being good custodians of the public purse. We will talk macroeconomics with Christian Keller shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Focus on the Fed. The central bank is expected to downshift this week on interest rate hikes. But inflation data out Tuesday could complicate matters. Power prices in the UK jump to a record. Freezing temperatures cause a surge in demand, while a drop in wind generation leads to a supply crunch. And two multi-billion-dollar deals making news. Bloomberg's learned that Amgen has agreed to buy Horizon Therapeutics at a $26 billion valuation. Meanwhile, Microsoft is taking a stake in the London Stock Exchange Group. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, yeah, we can talk about where futures are this morning, jumping a little, incidentally, from the weakness of Friday. But really, it's a focus on the middle of the week, the data and the central banking decisions still to come.
Yeah, absolutely. I mean, we get CPI out tomorrow, and as Valerie Teitel was telling us at the top of the show, over the last 6 CPI releases, we've seen the market move 3% or more. So it does look like we're seeing a little bit of a gain in futures right now, but there's a lot going on, and no doubt you'll see lower volume until you get that CPI release out, and then again until you get the Fed decision on the next day. Right now, the 10-year yield is coming down a little bit as investors buy the treasuries. Right now, 350, 342 is the level. I keep mentioning we've gone to 4.25 just about 2 months ago, and most strategists on the street are betting that investors are going to buy treasuries, and the yields have spiked. NYMEX crude right now is off about 0.6%, $70.61 a barrel. It's the lowest level we've seen since December 20th of 2021, so almost a year since we've seen levels this low, and that speaks to the bearishness in terms of a forecast for the economy, the global economy, really not being helped by the reopening in China that we're seeing. And then Bitcoin right now off 0.75%, $16,981, but it's been hovering around 17,000 for the past few sessions, climbing up a bit from the $16,000 level since the collapse of FTX. Kailey, what do you see in the pre-market?
Well, it is a merger Monday, and Anna was mentioning some of this in the headlines, but one of the big stories of today is Amgen buying Horizon Therapeutics with about a 20% premium compared to Horizon's closing price on Friday, $116.50 a share. That is equivalent to roughly $26 billion. And as a result, that stock is up about 12%, trading at 109 right now. Amgen, for its part, a little bit lower, down about 0.5%. But of course, that would be its biggest deal ever. Now, another deal, though it isn't an outright acquisition, is a 4% stake bought by Microsoft in the London Stock Exchange Group. Microsoft shares up about 0.3%. And I know Anna will have the update on LSE as well. One deal, though, not happening. Rivian is abandoning its joint venture to make electric vans with Mercedes-Benz in Europe. They're instead going to focus more on their own consumer and commercial vehicles. So as a result of abandoning that pact that was signed only 3 months ago, Rivian shares are down about 4% before the bell, Anna.
Kailey, European equity markets then under a little bit of pressure this morning, down by 0.4%, playing catch-up with Wall Street at Friday, though, as we see US futures looking a little bit more buoyant, as Matt just pointed out. Brent crude is down by 0.6%, 75 now the handle on that oil price. Our colleagues on the Markets Live blog talking about how the Kremlin's response to the cap that we've seen agreed, certainly at European level, G7 leaders discussing as well. The Kremlin response to that, certainly something that we'll still need to watch out for, also pointing to the possibility of short covering happening on oil prices, that's got to be a risk to the upside, according to our colleagues on the Markets Live blog. 122.76 on the pound. Just putting this one in there because we do, of course, have the Fed meeting, but we also have the Bank of England meeting, and there's so much uncertainty about the path ahead for the UK economy. Just what does the Bank of England decide is going to be something to watch later on. And as Kailey was referencing the Microsoft share price, here we have the London Stock Exchange Group and Microsoft taking a 4% stake in this business. It is, of course, a trading business. It's also very much a data business now after that Refinitiv deal was finally done last year then, Kailey. And as a result of that, Microsoft and LSE Group doing some interesting stuff around cloud and artificial intelligence. And in fact, their AI and cloud boss at Microsoft will now sit on the board of the London Stock Exchange Group.
Yeah, Anna, so some very interesting micro stories on this Monday in a week that is largely going to be dominated by the macro, including the Federal Reserve, which will announce its final rate decision of the year on Wednesday. Ahead of that, we asked a few of our guests their thoughts about the strength of the U.S. economy.
I feel that right now things are going in the wrong direction.
Yeah.
We're entering a recession in most advanced economies, starting with the United Kingdom and the Eurozone, also in the United States soon enough. And inflation is still too high. So we're entering a stagflation like we've not seen since the 1970s.
I think it's premature to say that there is a Fed pivot. I mean, we saw another 100 basis points of Fed tightening to go. And then the question is it a pause? Is it really something that I would call a high hold, not a pivot? And I do think that that's really more the scenario that we see with recessionary risk in the U.S. rising towards the end of 2023.
Those are the aspects which I guess all the policymakers are trying to address. And over the next 6 to 12 months, I think that conundrum is probably going to be a bit more pronounced if Fed rates go higher and stay higher.
I don't think we're going back to the last 10 years that we had of acute financial repression. So I do think you will have a more normal interest rate environment going forwards.
These long forward rates are assuming that, 2+ years from now, a 2.5% Fed funds rate is in the bag. It is going back down for sure. Hey, that's a possibility, but I think that's highly overrated.
Joining us now to discuss the Fed further is Christian Keller, Barclays head of economics research. So, Christian, we're all basically anticipating a 50 basis point hike come Wednesday. The question is going to be surrounding the dot plot. What do you expect to see?
Exactly. I think, there's pretty much certainty that the Fed, but also the ECB and the Bank of England will go to 50 basis points increments. What we expect, though, in the dot plot and also in the communication, that the Fed will make clear that, the 4.6 median dot plot that they saw as a terminal rate in September is not enough. We think they'll put it probably to 5.1 or so by the end of 23, signaling very clearly to the market that they don't like really that the market is already pricing cuts for the second half of next year.
Okay, so that's what you expect to see around the terminal rate then for September 2023, taking it up then from 4.6 to something 5.1. Christian, what about financial conditions? Our colleague Valerie was earlier talking about how, financial conditions are actually pretty loose. The Bloomberg gauge shows conditions looser than when the Fed first started hiking, which is quite incredible given the amount of hiking that we have seen. Yeah. How much pushback against that do you think the Fed will give us?
Yeah, I think quite significant. I've called this a lot the pivot paradox, because there's a certain reflexivity here. By markets anticipating the pivot and then relaxing financial conditions, which they can. The Fed obviously has only control of the short-term policy rate. They can't control what happens to equity pricing. They can't control what happens to credit spreads. And those all have loosened. And, as you said, most indicators of financial conditions are back to where they were quite some time ago. In the meantime, the Fed has hiked, and the Fed will try to push back. They have to be careful. They don't want to outright be seen as trying to, bring markets down. But I think there'll be a lot of language on caution, on, that this is, they're going to continue to hike into 23, that they're not envisaging cutting soon. And they will hope that the market will take this for real.
And how does the China story weigh in here then, Christian? If we're looking at what the Fed is going to be doing this week and the narrative they'll give us for next year, I suppose a lot of people trying to assess how choppy the reopening story in China is going to be, how stop-start, and therefore what it's going to do to commodity prices. How are you factoring all of that in?
Yeah, that's a very good question. I think the market has been quick in repricing some of the equities in China, but it's not clear yet whether the market has really reacted to the potential reopening of China, because we had a very weak Chinese economy. Even the data we are seeing coming in now points to a very weak fourth quarter. Now, last week's pivot, if you want to call it that way, the COVID policy pivot by China is quite decisive. If China really opens earlier than expected and more forceful than expected, we think that could actually, not only lead to better growth, be welcome probably, particularly from Europe, to have a stronger export market again, but it would probably have an impact on energy. Remember that oil demand and natural gas demand by China was fairly weak over the last year or so. And if China opens up, in particular, transportation will demand more oil, and also the natural gas that in large part has been actually redirected towards Europe. If China needs this, you would expect that the market becomes tighter there again.
Yeah, I mean, doesn't it strike you as odd that we're seeing $70 barrels of oil here in the U.S.? I guess 75 for the global benchmark Brent. But at the same time, we're going to see, 100 million people filling their tanks up again within a couple months?
Yeah, look, the oil market is driven by so many forces. And, I, as a macroeconomist, I've given up trying to understand every move in the sense that, there's a lot of the supply issues and, and inventories, et cetera. I may not fully grasp at any moment of the oil market, but I think the tendency from here, if we see China coming back and the winter basically having also just started here in Europe, it's much colder than it was just a few weeks ago, you would think that the tendency of oil should be going higher, in particular, because the recession in the US seems to be not imminent. We see it coming in 23, but we just pushed it back actually to the second quarter. And so far, the US economy is also holding up quite well.
What do you think about the possibility of a real structural shift in the oil markets and global currency markets? I mean, if the Saudis start to sell a lot more oil to the Chinese priced in yuan, or, Zoltan Pozsar said it's unlikely, but if Putin decides to start charging, a gram of gold for a couple barrels of oil instead of dollars, would one of those things, you think, potentially really come to fruition?
Yeah, it's an interesting question. I mean, there's been a long debate of what, the dollar loses its primacy, not only a reserve currency, but also as the main currency in which basically all the commodities in the world are being traded. I don't see this coming yet. We have been quite skeptical of these announcements. But, look, over time, there is certainly something has happened. As you mentioned, the connectivity between energy, oil, and natural gas being produced in the Middle East, and Asia being, the main demand. Those things could have an impact. There would be more and more people wondering, why do we still price all this in dollar? But frankly, I don't think it's a near-term change. Maybe a longer-term structural change, but frankly, I think we're still a bit away from that.
Christian, thanks so much for your time. Christian Keller joining us there from Barclays. We will have a conversation about crypto shortly. On the crypto front, Reeve Collins will join us, former co-founder and CEO of Tether, who's now co-founder of SmartMedia Technologies. We will talk about what we're going to hear from Sam Bankman-Fried this week, that testimony. That'll be certainly one focus for the markets. Where do stablecoins head next then? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Heineken USA CEO Maggie Timoney. That's at 2:30 p.m. in New York, 7:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, FTX founder Sam Bankman-Fried is set to appear in the House tomorrow to testify about the collapse of his crypto empire. In a series of tweets, he said he would be limited in what he could tell the panel because he doesn't have access to all of his data. Joining us now for more on this is Reeve Collins. He's a former co-founder and CEO of Tether, who's now the co-founder of SmartMedia Technologies. And Reeve, it's great to get some time with you. Let me first get your overview. What do you think happened at FTX that Sam Bankman-Fried is either unaware of or not telling us?
Well, I really doubt that he's unaware of much that took place. It did grow really quickly. However, he was the CEO and maintained a really tight grip on everything that took place at both FTX and then I believe Alameda as well. So I don't think that he can plead ignorance on any of these charges.
So in that case, I mean, do you think there was commingling of funds going on? That seems to be pretty apparent. Was it fraud? I mean, I hate to make that kind of allegation without evidence, but I just wonder what your take is, since we've gotten the takes of pretty much everybody.
Yes, there's absolutely was commingling of funds, and now people are trying to determine how much SBF really knew. But at the end of the day, it doesn't matter. He was the CEO, so he either committed gross negligence or fraud. And at this level, either one should end him up in jail. He damaged over 1 million people, and he has to pay for that because he's ultimately responsible for everything that took place there.
Well, and it could not just mean repercussions for Sam Bankman-Fried himself, but the crypto industry as a whole, as we now have the focus of regulators and lawmakers renewed on this. How do you expect the tone to shift? What do you expect to hear in these hearings tomorrow, especially as there already has been effort to legislate crypto and stable coins as well, which goes back to Tether, that has struggled to see real finite progress? I mean, how do you expect things to change?
Well, tomorrow's going to be really interesting. So Sam's been on this apology tour for these last few weeks and really trying to win the hearts of the public. And we all feel that it's against the advice of his attorneys because he should just be quiet. But he's just facing potentially life in prison. So he's doing whatever he can to get people on his side, but I just don't think it's going to be successful. The media has been treating him for the most part very kindly, which is a big surprise. So we're hoping that after tomorrow, things shift a little bit and he ends up really feeling the heat and the pressure that's upon him because he really owes both the crypto industry and the general public a significant, not only apology, but he needs to pay for what took place.
Okay, so that is on his side, on the side of the parties that will be questioning him and potentially trying to make changes to laws as a result of this to avoid something like this happening again in the future. What should the composition of those changes look like, be it regulatory or legislative?
Yes, we do believe that there'll be a lot more regulatory oversight coming. And this has been a bipartisan issue. So even no matter what's been taking place in the House and the Senate, we feel that there will be more people leaning in. And a lot of the people in government are doing their best to be more educated and legislate responsibly. Unfortunately, actions like this will force legislation much quicker, so it might be broader reach than it needs to be. However, everyone's demanding some changes, which we do believe will be coming soon.
Reeve, good to see you. You obviously have your views on what happened here, talking about the possibility of gross negligence or fraud. These are obviously fairly serious things to allege that somebody has done. We'll wait for the legal process, of course, to run its course. But for you, then, is there evidence of those things? What is the best evidence that you've seen or read to make such a firm statement?
Well, for me, it's just my personal opinion that as the CEO, he is responsible for what took place. He can't claim ignorance. He can't claim poor management. And if he does claim poor management and ignorance, that's gross negligence. So he does need to hold himself responsible and his team. It is well known that he didn't have a CFO. How can you have an exchange of that size with no CFO? It's also quite surprising that these massive venture capital firms put in so much money and did all of this due diligence and with facts like that staring them in the face, and they still gave him the money. It's just time will tell and more stuff is going to come out. But at this point, it just all fingers point to him.
Okay, well, we'll wait to see what those facts are then. As the co-founder of SmartMedia Technologies, I mean, clearly the whole crypto space has really been shaken by this story, and to some extent it's reflected badly on other players in the sector, or at least raised ongoing questions about the sector. Is that something that you as a business have noticed? Is there less enthusiasm from big players in the financial space to get more involved in crypto?
Right now, everyone's taking a much more cautious approach and sitting on the sidelines for a little while. So that is being seen across the industry, especially at the exchanges. However, the technology continues to be built. This technology is only 10 years old. It took the internet 26 years from 1969 to 75 before it got some real commercial applications. So the technology is still being built. People still realize the impact it will have, and the ease of use, more regulation, and more applications are going to be built soon. And so more people around the world will feel what this technology can deliver. So that's what's being taken place right now. People are heads down and building.
I wonder about, your involvement with Tether. It's been an amazing run there. It's the most traded cryptocurrency on Earth. At the same time, Coinbase came out last week and said they'll waive fees for anyone who wants to convert Tether to USDC, implying that it's a safer technology. What do you say to the people who are concerned about a lack of transparency at Tether and who don't know which assets are backing their dollars there?
Well, it's an excellent question. And I believe what Circle or Coinbase did, because USDC is a joint venture between Circle and Coinbase. And this is just a purely competitive move. They're now marketing that their token is safer with no real proof or anything, but it is a marketing statement. And now there's free trades amongst, if you want to transfer your money from Tether to Circle, Tether to USDC. I don't believe that that's going to have much of an impact because those fees are pretty minimal. And so at the end of the day, people use these tokens for their utility, and all the stable coins, especially Tether and USDC, really provide tons of utility within the ecosystem and within cryptocurrency. So this is just simply trying to gain market share, going from the 46 billion and trying to shrink the gap between Tether's 69
for sure. But Reeve, it seems like Tether gets more and more transparent throughout its life, but doesn't ever share everything, right? Why wouldn't you just put everyone's mind at rest and just or why wouldn't Tether just put up, an actual live real-time accounting of all the assets backing the Tether out there?
I really do believe the principals are doing their best possible job and able to be as transparent as possible. They do have audits on their website, and it seems that the industry at times doesn't feel that's enough. I don't know how much more in-depth they'll need to go to alleviate all the naysayers, but it has withstood this test of time.
All right, Reeve, we have to leave it there, but thanks so much for joining us. That's Reeve Collins of SmartMedia Technologies and the co-founder of Tether. And for more crypto conversation, make sure to tune into Bloomberg Crypto tomorrow. That's Tuesday, as the FTX hearings get underway. Join us at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.